In 2025, entrepreneurs and investors face a brutal truth. The rules are changing fast, but the penalties for poor planning are even faster. Whether you're scaling a business or growing your portfolio, the difference between average and exceptional often comes down to how you handle tax. That's where this channel comes in. I'm a chartered accountant with deep expertise in international tax and advanced investing strategies. I've worked closely with entrepreneurs and investors across the UK and globally, and I've seen what separates those who just get by from those who build lasting wealth. If you're running a business, investing for the future, or simply tired of watching your hard-earned money disappear to taxes, this video is for you. Today, I'm revealing the exact strategies that top-performing entrepreneurs are using to legally eliminate taxes on their investments in 2025, especially in the UK. No gimmicks, no loopholes, just fully legal, government-backed methods, including real tools, deadlines, and insights you can act on right now. Let's dive in. The Individual Savings Account, or ISA, is still the crown jewel of tax-free investing in the UK. And in 2025, it's more important than ever, especially for high earners. Each UK adult can contribute up to £20,000 annually. For couples, that's a combined £40,000 sheltered from both income tax and capital gains tax. Over 10 years, that's £400,000 of capital allowed to grow, completely tax-free. But here's where it gets strategic. Let's say you consistently invest your full allowance each year into a low-cost, globally diversified equity ETF. With a conservative 7% average return, your ISA could grow to over £550,000 in a decade. That's a substantial compound gain, untouched by HMRC. And this isn't theory. According to HMRC's latest figures, over 13 million adults now use ISAs. It's no longer a fringe strategy, it's mainstream, powerful, and essential. Now, if you're in the higher or additional rate tax band, the benefits compound even further. Dividends, which can be taxed up to 39.35%, and capital gains, up to 20%, are entirely shielded inside the ISA. This turns every pound of growth into a pound of net wealth. Here's how to optimize this further. Prioritize stocks and shares ISAs. They're ideal for long-term, equity-based growth and give you full flexibility on asset allocation. Consider global ETFs that track indexes like the MSCI World or S and AMP Winking and Tongue Poking Smiley 500, which historically return 6 to 8% annually. Reinvest your dividends within the ISA for compounding acceleration without any tax leakage. For those seeking higher income potential, there's the innovative Finance ISA, which allows tax-free investing into peer-to-peer lending and alternative debt products. These offer yields of up to 8 to 10%, though they come with higher risk. And if you're under 40, don't overlook lifetime ISAs, which give you a 25% government bonus on up to £4,000 annually, a smart move if you're planning for your first home or long-term retirement. One final tip: unlike pensions, ISAs have no withdrawal restrictions and no reporting requirements to HMRC. That's huge. It makes them one of the most flexible and compliant tax wrappers available in the UK today. So the takeaway is simple. If you're not fully using your ISA allowance every year, you're giving up guaranteed, tax-free growth and missing one of the most generous benefits in the UK tax code. Formerly known as Entrepreneurs Relief, Business Asset Disposal Relief, BADR, lets you pay just 10% capital gains tax on business sales up to £1 million in lifetime gains. This is especially powerful when compared to the standard 20% CGT rate, effectively halving your tax bill. Eligibility hinges on 3 core tests: owning the business or shares for 2 years, having 5% or more shareholding, active involvement in the company. To put it into perspective, if you sell your business for £1 million with £700,000 in gains, you'd save £70,000 in taxes under BAD. With exit activity rising in sectors like tech, e-commerce, and healthcare, entrepreneurs must plan disposal strategically, preferably before the end of the tax year. Pension contributions aren't just about retirement, they are among the most efficient tax shelters available. For 2025, the annual pension contribution limit stands at £60,000, and this amount attracts full income tax relief, often worth up to 45% for higher earners. That means a £60,000 contribution could reduce your tax bill by £27,000, effectively increasing the amount you're able to invest for the future. And it gets better. You can carry forward unused allowances from the past 3 tax years, potentially contributing up to £180,000 in a single year while still claiming full tax relief on the entire amount. Even better, pension funds grow tax-free, meaning any dividends, interest, or capital gains within your pension aren't subject to tax, allowing your investments to compound faster. Plus, once you reach age 55, you can withdraw up to 25% of your pension savings tax-free. Many entrepreneurs choose to set up a self-invested personal pension, SIPP, to maintain flexibility and control over their investment choices, giving them the freedom to tailor their pension to their specific financial goals. If you're an investor with a risk appetite, venture capital schemes offer exceptional tax relief. The Enterprise Investment Scheme, EIS, allows you to invest up to £1 million annually, claiming 30% income tax relief. That's a potential £300,000 in tax savings. The Seed Enterprise Investment Scheme, SEIS, is even more generous for early-stage companies. Invest up to £100,000. Receive 50% tax relief. Capital gains exemption if held for 3 years. These schemes are not only about tax. They support innovation and provide exposure to high-growth startups. Platforms like Seedrs, Crowdcube, and Syndicate Room simplify access to EIS or SEIS opportunities and are FCA regulated. Just ensure due diligence. Not all startups succeed, but those that do can offer both outsized returns and significant tax sheltering. If you're still operating as a sole trader, it might be time to consider incorporation. Why? The corporation tax rate is currently 25%, while income tax on higher rate earnings can reach 40% or more. By forming a limited company, you can draw a small salary plus dividends, reducing national insurance and personal tax exposure. Let's say you earn £120,000 as a sole trader. You could pay over £40,000 in tax and NICs. But through a limited company structure, with proper planning, your total tax could be slashed by up to 30%. Tools like Free Agent, Xero, and QuickBooks can streamline compliance and accounting for limited companies. Just ensure your structure suits your business goals and sector. Not all entrepreneurs benefit, so seek bespoke advice. Many entrepreneurs miss out simply by forgetting deadlines. Here are the key ones for 2025. The 5th of April 2025, end of the tax year. Max out ISA, pension, and EIS for SEIS limits by this date. The 31st of January 2026, file your 2024-25 self-assessment return and pay any tax due. Also note, the 31st of July 2025 second payment on account, if applicable. Setting up automated reminders or using tax tools like Tax Scouts, Go Simple Tax, or Untied can keep you ahead of HMRC and optimize your planning. These aren't shortcuts. They are government-approved, time-tested strategies that, when implemented with precision, can save you thousands or even millions in taxes. If you're serious about protecting your wealth and scaling smartly in 2025, this is your edge. Hit the subscribe button to access weekly videos crafted for entrepreneurs, investors, and high net worth individuals. Leave your questions below, and I'll address them in upcoming content. Thanks for watching, and here's to building smarter, tax-free wealth.